13.5%. That is what one Singapore-listed company lost across 7 trading sessions this month. It makes test equipment for semiconductors. Its name is AEM, and on the 17th of August it closed at $10.48. 7 trading sessions later it closed at $9.06. Almost nobody outside Singapore wrote about it, because New York was doing the same thing to much bigger names at the same time. Then, at 1 o'clock on the afternoon of Wednesday, the 26th of August, 2026, Singapore's Economic Development Board published a table. Inside it was a line for semiconductor equipment production. That line printed 136.3. It is the highest reading in the entire history of the series, and that series starts in January 1992. So here is the question this whole video is built on. If the machines are being made at a record rate, why did the market spend the preceding fortnight selling the people who make them? I have 4 candidate answers. 3 of them survive contact with the data, 1 does not. Let me show you the numbers first, and then let you decide which one you believe. Chapter 1's the number at 1 o'clock. Singapore publishes its factory data once a month, under embargo at 1 in the afternoon. The July release landed on Wednesday, the 26th of August. I have the media release in front of me. The embargo line is printed on every page. The headline, manufacturing output rose 6.8% year-on-year. That is the number that went out on the wires. It is also on its own close to useless. And I want to show you why before we go anywhere near the interesting part. 6.8% is an average of 6 clusters that were doing wildly different things. Chemicals fell 10.6%. Inside chemicals, petrochemicals fell 48.7%. It's not a typo, nearly half the output gone year-on-year. Biomedical manufacturing fell 5.3%, dragged by pharmaceuticals at minus 14.3%. Now hold those 2 next to the other 4. Precision engineering rose 17.7%, electronics rose 11.2%, transport engineering rose 10.8%, general manufacturing rose 4.9%. 4 clusters up, 2 clusters down. And the 2 that were down are the 2 with nothing to do with computing. You can see this in the government's own alternative headline. Excluding biomedical manufacturing, output rose 8.0% rather than 6.8%. The board publishes that second number every single month, precisely because biomedical swings so violently that it makes the headline unreadable. Ask yourself what a 6.8% economy-wide factory number is actually telling you, when one of its parts is down 49 and another is up 18. It is telling you almost nothing. The average is hiding the story. So let me go one level down where the story is. Every cluster in that table carries a weight. Its share of the index. Electronics is the giant at 40.2%. Chemicals is 15%. Precision engineering is 15.2%. Biomedical is 11.3%. Transport engineering 9.6%. General manufacturing 8.7%. And inside precision engineering there is a subline called machinery and systems. Weight, 12.4% of all Singapore manufacturing. The board's own description of what happened in that line is 1 clause long. Quote, the machinery and systems segment recorded higher production of semiconductor equipment. That is the sentence, that is all the release says about it. It grew 18.2% year-on-year in July, faster than the semiconductor segment itself, which we will get to. 1 clause buried in a subparagraph on page 2 of a 5-page release. I think it is the most interesting number Singapore published this month, and I do not think anybody traded on it. Here is why I say that. Chapter 2, 34 years. A growth rate on its own can lie to you. 18.2% sounds strong, but strong compared to what? If last July collapsed, this July only had to show up. So I went and got the levels, and I would encourage you to go and get them too. This is all public. Singapore's Department of Statistics publishes the underlying index through its table builder service. The board's own media release links to it. Table M355381, Index of Industrial Production by Industry Cluster, rebased so that the average of 2025 equals 100. I pulled the whole series, 415 monthly observations for machinery and systems, running from January 1992 to July 2026. Here is what July 2026 printed. 136.348. Now here is the part that matters. That is not the highest reading of the year. It is not the highest reading since the pandemic. It is the highest reading in all 415 months. 34.5 years of data, the top of it is last month. The second highest is June 2026 at 135.46. Third is January of this year at 129.22. Do you see the shape? The three highest readings in the history of the series are all inside the last 8 months. And the pattern repeats one level up, the precision engineering cluster as a whole, machinery and systems plus precision modules and components, printed 132.915 in July. Also an all-time high. Also the second highest reading is June 2026. I want to be careful here about what that does and does not mean, because this is where these arguments usually go wrong. It does not mean Singapore is the biggest maker of chip equipment in the world. It is not. This is an index of volume against a base year, not a measure of scale. It does not mean any particular listed company had a record month. The index counts everything produced in Singapore, by multinationals with plants here as much as by anyone listed on the exchange. And there is one more caveat printed in the release itself, as a footnote on the July column. The letter is small and the word is short. Preliminaries. July's figures can be revised. They usually are a little, so treat 136.3 as a first estimate, not a carved number. With all three of those caveats in place, the claim still stands. By the government's own measure, more semiconductor manufacturing equipment came off Singapore's lines in July than in any month it has ever counted. Now let me tell you what the market had been doing while that was happening. Chapter 3: What New York had already decided. 6 trading sessions, that is the window I want you to hold. From the close on Monday the 17th of August to the close on Tuesday the 25th. The last completed United States session before I sat down to write this. In that window, the Philadelphia Semiconductor Index went from 12,621 to 11,588. Down 8.18%. Now break it apart because the inside is more interesting than the total. Take the 5 semiconductor equipment makers inside the Nasdaq 100. Applied Materials down 10.32%, KLA down 10.90%, Lam Research down 8.49%, ASML down 7.38%. And Teradyne, which makes chip testers, down 17.31%. All 5 same direction, same fortnight. That group averaged minus 10.9. Now compare that to the chip designers over the identical window. Nvidia fell 5.32%, AMD fell 5.30%, Broadcom fell 9.09%, Marvell actually rose 2.58%. That group averaged minus 4.3%. So the equipment makers were sold about 2.5 times as hard as the designers. And the memory names were sold hardest of all. Seagate down 17.40%, SanDisk down 17.13%, Western Digital down 15.91%. That is the shape of it. Memory worst averaging minus 14.6%, Tools second at minus 10.9%, Designers third at minus 4.3%, and Design Software barely moved at all. Synopsys down 1%, Cadence actually up 2.6%. Now come back to Singapore, because the same thing happened here and almost nobody wrote about it. AEM, which makes semiconductor test handlers, closed at $10.48 on the 17th. It fell on the 18th, the 19th, the 20th, the 21st, and the 24th. 5 consecutive down sessions. By Wednesday's close, it was $9.06. 13.55% gone. UMS Integration, which makes precision components for the equipment makers, fell 5.57% over the same window. Franken fell 7.97%. Venture Corporation, bigger, more diversified, and actually in the Straits Times Index, fell 1.64%. So the further you got from the semiconductor tool chain, the less you were sold. That is not a random walk. That is a market forming a view about one specific industry and expressing it across 2 continents at once. And then, at 1 o'clock on the 9th trading day of that sequence, the Singapore government published a number saying that industry had just had its best month since 1992. What do you do with that? I want to be honest with you about the timing here because it is the crux. The selling came first, the data came after, nobody was reacting to that print. It did not exist yet. Which means the question is not why the market ignored the number. The question is whether the number should have changed anybody's mind afterwards. Chapter 4: The Tools and the Chips. Here is the split that I think does the real work. Singapore's index has a semiconductors line and it has a machinery and systems line. One counts chips, the other counts the machines that make and test chips. In July, the machines beat the chips, and it was not close. Machinery and systems up 18.2% year-on-year. Semiconductors up 8.0%. Look at the weights though, because they cut the other way on you. Semiconductors are 32.6% of all Singapore manufacturing. Machinery and systems are 12.4%. So the smaller line grew more than twice as fast as the line that is nearly 3 times its size. And in levels, the divergence is starker still. The semiconductor index peaked in May 2026 at 138.049. That was its all-time high and it has not been back. June came in at 105.11. July recovered to 119.99. So Singapore's chip output in July was 13% below where it was in May. The equipment line did the opposite. It went to a record in June and a slightly higher record in July. 2 lines in the same table in the same economy in the same month, pointing in opposite directions. Which one would you trust to describe the cycle? What would make that happen? The honest answer is that this is exactly what the early to middle innings of a capital equipment cycle look like. Tools get built and shipped before the capacity they create comes online. Equipment output leads fab output. It has to by construction. If you believe the artificial intelligence build-out is still in its capital expenditure phase, this is the fingerprint you would expect to find. Machines first, wafers later. If you believe the build-out is rolling over, you would expect the equipment line to turn first, because orders get cancelled before capacity gets idled. As of July, the equipment line had not turned, it went up. Now, that is 1 month, and a single month of a preliminary, non-seasonally adjusted index is thin evidence for anything. So let me deal with the strongest objection to everything I have just said. Chapter 5, 8% is a measurement of last July. Somebody reading that release could tell you a completely different story, and you should hear their case at its strongest before I take it apart. Their case goes like this. Singapore's semiconductor output grew 53.3% in May, 20.8% in June, 8.0% in July. 53 to 21 to 8. That is a collapse. The artificial intelligence boom is cooling in the one place that physically measures it. If you saw only those 3 numbers, you would believe it. I did for about 10 minutes. It is a good argument. It is also mostly wrong, and the reason is arithmetic rather than judgment. A year-on-year growth rate has 2 ends. Everybody watches the front end. This year, almost nobody checks the back end. When did you last check the denominator of a growth rate somebody quoted at you? So check it with me. The semiconductor index in May 2025 was 90.03. In June 2025, 87.01. And in July 2025, 111.06. The base jumped almost 28% in a single month, not this year. Last year. That is what changed. July 2026 is being measured against a spike, and May 2026 was being measured against a trough. Same factories, different yardstick. Here is how much of the drop that explains. In log terms, roughly 60% of the fall from 53% to 8% comes from the base rising. The other 40% is real. Output genuinely came off May's peak. So it is not nothing, but it is not a collapse either. The clean way to see through it is a 3-month average, which cancels both the base spike and most of the seasonality. Do that with me. May to July 2025 averaged 96.03. May to July 2026 averaged 121.05. Up 26.0%. 26, not 8. And the board's own cumulative column, January through July, says semiconductors are up 28.7% on the year. So which number would you quote? 8, 26, or 29? They are all correct and only one of them made the headlines. Chapter 6, 4 readings, 1 test. So we have a record in the output data and a double-digit drawdown in the share prices. 4 explanations are on the table. Let me put each one where it can be checked. The first. The market is looking forward and the index is looking back. This one is strong and it is probably most of the answer. Equipment that shipped in July was ordered 6 to 12 months earlier. A record July tells you about the order book of last autumn. It tells you nothing about the order book of next spring. Nothing in Singapore's data can refute a view about 2027. Nothing. The second, the market is repricing margins, not volumes. The trigger for the worst session in this sequence was a story that ran in the technology trade press around Monday the 24th of August. Tom's Hardware and Benzinga both carried it. Nvidia, it was reported, has warned large customers that servers built on its chips will cost more than 15% more from early 2027 because memory has become expensive. I want to flag that as carefully as I can. That is a reported plan. Every outlet carrying it uses the word reportedly. I have found no confirmation from Nvidia itself, and Nvidia's own quarterly results were not due until after this video's research cutoff. But look at what the market did with it. Memory names fell hardest of all. Seagate down 17.4% across the fortnight. Stop and think about how strange that is. If the story were artificial intelligence demand is dying, the memory makers selling into those rising prices would be the last thing you sold. They were the first. That points at margins and input costs, not at volumes, and a volume index cannot see margins at all. The third, the index is measuring the wrong thing. This is the honest limit on my own evidence, so let me state it plainly rather than bury it. The index of industrial production counts physical output. It does not know what anything sold for. If tool prices are falling while unit volumes rise, that index climbs to a record while the industry's profits shrink. You cannot get earnings out of it, do not try. The fourth, demand has already fallen and the data has caught it. That one fails not on opinion. On the number, as of the last month Singapore has published, the equipment line did not turn down. It set a record, and the month before it set the previous record. 3 of 4 survive. The one that does not is the simplest, which is usually how it goes. So what does the market do next with a number like that? Chapter 7, Singapore did not trade it. Nothing, that is the answer, it did nothing at all. Picture the timing. The release went out at 1 in the afternoon, with the Singapore market open and 4 hours of trading still to run. Plenty of time to react if anyone wanted to. The Straits Times Index closed that Wednesday at 5,721.59, down 14.09 points. Down 0.25%. That is not a reaction, that is a Wednesday. Hold that beside the 13.5% you heard at the start. And the names most exposed to the line that hit a record, AEM fell another 2.58% that afternoon. UMS closed unchanged at $2.71. Franken closed unchanged at $2.54. I checked all three against 2 independent price sources, and they agree. Now step back and look at the fortnight whole. From the index's record close of 5,768.46 on the 17th of August, the Straits Times Index fell 0.81% to Wednesday. Over the identical window, AEM fell 13.55%. One of those is a benchmark that barely contains this industry. The other is the industry. AEM is not a Straits Times constituent, which is exactly why the index tells you nothing about what just happened to Singapore's chip tool chain. 2 questions worth sitting with. Should a monthly volume statistic move share prices at all? Reasonable people say no. It is backward-looking, it is preliminary, and the companies themselves report quarterly. But if the answer is no, then what were the equipment stocks pricing over those 6 sessions? Because it was not July's shipments. They had not been published yet. Chapter 8, The Bound. Let me put the claim at its narrowest, because a narrow claim is the only kind worth defending. Through July 2026, Singapore's semiconductor equipment output was at the highest level ever recorded in a series that starts in 1992. That is a fact about the past. It is preliminary and it may be revised. Everything else in this video is an argument about what that fact rules out, and it rules out less than it looks like it does. It rules out one thing cleanly. Anyone telling you the artificial intelligence capital cycle had already turned by mid-year is contradicted by the physical data of the economy that builds a large share of the tools. It rules out nothing about the second half, nothing about pricing, nothing about margins, nothing about any individual company's earnings here or in New York. And to be completely clear about what this is, none of it is financial advice. I am not telling you anything is cheap, dear, or worth owning. I am telling you what 2 sets of numbers said and where they disagree. So here is the test, and the date is already fixed. The board publishes August's figures on the 28th of September 2026. Watch the machinery and systems line. Not the headline, not the 6-cluster average, and not the year-on-year rate on its own. The level. If it rolls over while the equipment stocks stay down, the market read the cycle early and I was looking at a lagging indicator. If it makes another high while those stocks keep falling, then the disagreement is not about how many machines get built. It is about what they earn. And that is a different argument entirely, fought with different evidence. Either way, one of us is wrong by the 28th of September. I would rather find out than guess.